Hello there, hello and welcome to Money Control. Thank you for tuning into the IPO Corner. I'm your host Nickey Mirchandani, and today we're going to be talking about SAMHI Hotels is now a listed entity, perhaps reporting the first quarter numbers out there for you. The company has reported net loss, but the losses have narrowed down from what they were in the previous quarter. Of course, to know more about the road ahead of the company and the outlook going forward, we're being joined by the company's managing director and the CEO, Ashish Jakhanwala, here with us. Afternoon there. Just the
Good
initial
afternoon.
assessment of your numbers. We've spoken during the time of course, your fundraising, that's the IPO. Let's start off with your bottom line. For the last consecutive 3 years, there were losses. This time around, too, you have reported in losses but narrower as compared to the corresponding quarter of the previous year. When does the company expect to be completely turning around on the bottom line front and the drivers that essentially which could lead to the road of profitability?
Thanks, Nick, to have me here. So you're absolutely right. Obviously the first 2 years, 21, 22, heavily impacted by COVID. Then in FY23, there was a substantial impact of finance cost on our bottom line. If you see in the first quarter in the current fiscal year, our PAT losses have been 83.5 crores. Interestingly, if you see, this is a quarter we had to report because under the new regulations, every listed company needs to report the prior quarter within 21 days of listing. So all of the efforts that we made in IPO recapitalization, reduction of debt, the impact of that is not visible in quarter one. Actually, impact of that will hardly be visible in quarter two as well, because as you know, the IPO happened on 22nd of September. But if we just look at numbers in perspective, our loss was 83.5 crores. The finance cost was about 107 odd crores for the same quarter. If you look at the reduced debt in the company as of date, that finance cost would come down from 107 crores to about 60 odd crores, right? So adjusted for that, our losses would, on the same quarter number basis, would have been barely about 35, 36 crores. And that also includes some ESOP expenses and one-time cost. So actually, if you see on a EBITDA run rate and the current level of debt and the finance cost we have, the company would probably just be at about 18, 20 crores of losses if you were to make an estimation, right? Without changing the EBITDA numbers. On the other hand, what we are seeing is a pretty encouraging growth, both in revenue and asset level EBITDA. So if you see our revenue grew at almost about 14%, our asset level EBITDA grew at about 12.5%. So on one side, you're seeing the assets contributing well to the profitability, and the finance cost is going to be significantly lower from quarter three onwards. So Nicky, I would believe with the simple mathematics, if we continue that 12-13% EBITDA growth rate and our debt has come down, the finance cost has come down, we'd like to believe that in the next few quarters, the company is definitely in a position to report a profit. But just to add to that, a more important factor is the fact that we'll start producing free cash from quarter three. Because if you look at our 83.5 crores of losses, that, as I said, includes about 107 crores of finance cost. It also includes about 23 crores of depreciation and 11 crores of ESOP expenses. So both depreciation and ESOP expenses are non-cash. So from quarter three onwards, we are fairly confident the company will start producing free cash, which obviously then paves the path for both growth and further deleveraging.
Sure. Let's also talk about, you just said that you expect the free cash flow generation to take place in the quarter third and perhaps a turnaround in your profitability in the same quarter itself?
No, so profitability I would expect more towards the end of the fiscal year. Because the ESOP cost of 11.5 crores per quarter, Nickey will continue till quarter four, and after that it substantially reduces to just about 4 crores a quarter, and obviously it kind of completely gets knocked off in a 3-year period. So we would believe the profitability would be more towards the end of the fiscal year, free cash immediately post the first quarter after IPO, which is the quarter three.
All right. Let's also talk about your operational performance. In this quarter gone by, it's down by 14%. What has dragged down the operational performance year-on-year basis? What's weighing down? And also what can be expected on a steady state basis going forward?
So actually, again, there is that impact of the ESOP and one-time expenses. The
Sure.
asset EBITDA actually grew by 12.5% year-on-year. So from 65.8 crores, it went to 72 crores. If you adjust it for the corporate overheads, even then there was a growth of about 9% year-on-year. The margins before the ESOP and the one-time expenses have remained in the 34% benchmark, so really not material shift. whatever is the dilution you're seeing in the margins between 34% to about 25% between last year, first quarter last year, this year, is largely on account of ESOP expenses and one-time cost, Nickey. But at an operating level, we've seen revenue grow at about 14%, EBITDA grow at about 12.5%, and that momentum actually continues through the second quarter as well,
All right, if I'm just supposed to simplify this a little more for the viewers, so your EBITDA adjusted for your ESOP has grown by how much?
So if you see your EBITDA adjusted for ESOP has grown by about 9% year on year.
Okay, and what's the growth that you're estimating going forward? Is the ESOP typically going to be similar traction that we're looking at on the steady state basis for the quarter gone by? Is that going to be a permanent entry there? And also,
no, it won't be a permanent entry. As I said, for the current fiscal year, it will be about 11 crores a quarter till the quarter 4. And from the first quarter FY25, it materially drops to just about 4 crores a quarter. So you will see a significant reduction in ESOP costs starting 1st April 2024.
And how much that would be?
So from 11.5 crores to 4 crores, so about 7 crores savings there.
All right. And going by the logic that we have, that because you've kept that number for the entire fiscal year, so EBITDA adjusted ESOPs for the next quarter, what kind of operational performance growth can be anticipated?
So Nickey, in quarter 2, and this is a number we've actually disclosed in our management presentation, one of the key parameters that we evaluate is revenue available per room, right? The RevPAR growth in quarter 1 was about 14.2%, or just let's say 14%. In quarter 2, we have seen the same RevPAR growth grow to about 15% year on year. The early indication, the early operating indicators we are seeing for instance, the month of October, we're seeing a significant improvement in those RevPAR growth margins at a hotel level. So Nickey, I think we're seeing the EBITDA growing pretty well. If I compare it to the last year, right, we are seeing the growth of almost at an operating level about 12% year on year, which as we get into stronger quarters, which is quarter 3 and quarter 4, if we have done 12.5% in quarter 1, which is probably the weakest quarter in the year, as we move into quarter 3 and quarter 4, we expect operating income from the assets to be definitely superior than 12.5% year on year. And as I said, from quarter 3, we have free cash that also helps us continuously deleverage the balance sheet and further reduce our finance cost.
So hanging on to that thought for a while, let's just focus on revenue per available room, which has grown by 14%. The segmental wise breakup behind the growth number, and going forward, do you expect this number you said in this quarter, how much is expected to grow by?
So if you look at how different segments have performed in our portfolio, the RevPAR has grown upwards of 7%. So, we have these categories that if it is between plus minus 2%, Nickey, we say it's flat, right? If it's between 2 and 7%, it's moderate growth, and above 7% is a good growth. So RevPAR in all 3 segments, which is mid-scale, upper mid-scale, and upscale, has actually grown in what we call the highest segment, which is upwards of 7%, right? Now, on quarter by segment, we believe the numbers have too much, noise. But what we know is all segments have grown upwards of 7% year on year. Cumulative RevPAR growth has been about 14%, right? So all sectors are showing good growth on RevPAR basis. Rate growth has been actually, Nickey, the most important measure. If you see year on year, the average rate growth across our portfolio for the first quarter was about 17%, right? So the occupancies are plus minus at 71, 72%. Actually, the occupancies have dipped about 1.5 points. But the rate growth is the most exciting part, where we've seen about 17% rate growth in the first quarter. We're seeing a very similar traction in the quarter 2, and going into the quarter 3, the first few days, if there are any indicator of how the quarter will be, it's very encouraging.
Okay, so 17% goes down to 14%, if I'm not wrong, and the 14%...
70% is rate growth, 14% is RevPAR growth.
Okay, so RevPAR growth of 14% is expected to remain as is for the next quarter also, year-on-year basis?
Yeah, so actually quarter 2, we expect it to be improving by another percentage point. So what was 14% in quarter 1, we expect it to be 15% in quarter 2, RevPAR growth.
All right. So going by that logic, still coming back to the same question. So your EBITDA growth in that case, ex your ESOP, will be how much if you are looking at a 15% growth on your RevPAR for the next quarter, year-on-year basis?
So Nickey, interesting. It's actually a very good question because, when you see the first quarter and you see a 14% revenue growth, but you see an EBITDA growth of 12.5%, Typically, we would like to see EBITDA growth remain actually same or higher than the revenue growth because of the way the fixed and the variable cost structure is in the sector. But as you know, the last year, first quarter, actually the first 2 quarters, what we had seen is that the hotel companies had taken significant steps to cut down their operating expenses. So the base was much lower. That's why what you're seeing on the operating expenses that increased slightly higher than the revenue, and therefore your EBITDA growth is lower than the revenue growth. Going into quarter three, quarter four, Nickey, if we maintain this 14-15% RevPAR growth, you would definitely see EBITDA growth being that much or higher than that, because the cost basis is is kind of neutralized last year same time. So we actually feel reasonably confident with the occupancy levels remaining above 70% through the first 2 quarters, rate growth being about 16-17%. We expect the EBITDA growth in the quarter three, quarter four, will be definitely in the range of 15% plus.
Okay, that's quite a proper projection, I would say. Also, your targets going forward, when I speak about the company, already has 31 hotels. It's got 4,800 plus rooms as we speak, 13 consumption centers, operates hotel brands like Hyatt, Four Points, Courtyard, Fairfield. What's next? What's the big target for the company?
So, Nickey, we've obviously grown well over the last several years, except for, of course, the last 3 because of the pandemic, right? In the next, I'll give you the guidance for the next 2-3 years, because most of that growth is actually organic, internal. So our first focus, as I said, and that's why I think, I'm sorry, I'm being repetitive here, but what is more important for us is to start producing free cash from operations, which we are reasonably confident will happen from quarter 3 onwards, right? Part of that free cash goes towards continuous reduction in debt. Our target is to go down to 3.5 times by FY25. But part of that cash goes towards creating additional inventory. So we are kind of quite ready to open a new hotel in Calcutta by end of next calendar year, right? So I would say by end of quarter 3 FY25. It's a 111 room hotel to be branded as Holiday Inn Express. We are adding inventory of rooms to our hotel in Bangalore, which is Holiday Inn Express in Bangalore Whitefield. We expect to add certain service departments to our Hyatt Regency in Pune. So in all, Nickey, today we have 4,800 rooms which are operating. By the end of FY25, we feel that will be just shy of 5,000 rooms. And then in the next year and a half or so, we open a very large asset in Mumbai, which will then, along with a development in Chennai, will take us to about 5,400 rooms. So a large part of our free cash is going to be used towards adding 600 rooms to our portfolio, starting next year when we add about 180 odd rooms between Calcutta, Bangalore and Pune. And then in the long term, we add more inventory in Chennai and Hyatt Regency Pune. And in addition to that, we're going to spend about 120 odd crores in renovating and rebranding 900 rooms of the existing 4,800 rooms. So with the free cash that the company starts getting from effectively the December quarter, we actually are going to reinvest a lot of that capital in activities which are typically very high ROCE, because large part of capital expenditure has already been incurred on those assets. Those assets are ready with the company, and impact of that you'll start seeing, as I said, from FY25 onwards.
What kind of free cash flow generation are you expecting from quarter 3, and what is your capex requirement for the ongoing year? How much of that will be debt?
So, Nickey, if you see, we think that at a different range of estimates, if we take last year H2, for the H2, the EBITDA was about 172 crores, 175 crores. And in that, I'm including the ACIC portfolio that we acquired in August, right? A lot of numbers that we are talking about right now for the first quarter does not include the ACIC acquisition, right? So that acquisition got completed in August. So quarter 3 will report the full portfolio as a part of our business, right? So H2 last year, including that business, our EBITDA was about 170 crores, 175 crores. We expect that EBITDA to obviously continue to grow in the same zip code that we've seen in the first quarter, which is about 12.5% plus minus, right? With that and our finance cost coming down to almost about 110, 120 crores for the H2, right? We actually expect the company has the capability to produce about 60, 70 crores of free cash in the second half of this fiscal year, right? In terms of capital expenditure, between now and the end of FY25, we expect the total capital expenditure to be approximately, we would say, 180 to 100 crores. And all of that we funded from the free cash, because as I said, 6 months cash flow will be in the zip code of about 50, 60 crores. 18 months, of course, much higher than that.
All right, so there's pretty much foolproof there. But just in terms of this capex, the capex for this year, the 80 to 100 crores, what is the projection in terms of the expansion for FY25, which is targeting additional 181 rooms before the end of FY25 and a couple of renovation plans that you have. But for this financial year, what is doable in terms of the addition and what is the kind of capex you're attaching to?
So, Nickey, capital expenditure this fiscal year will be just about 40 odd crores because a large part of the capital expenditure in hotels which are nearing completion comes towards the end. So this fiscal year, we expect only about 45 crores of capital expenditure. And that does not result in any inventory addition in the current fiscal year, right? The inventory addition will only happen in FY25.
Talk about your debt levels, net debt to EBITDA for that matter, and also your finance costs that you just spoke right at the opening remarks. What kind of finance cost are we looking at even for quarter two? Because I believe the company is going to be reporting in a finance cost for quarter two, quarter three, before it finally turns around in quarter four, correct?
Yeah, Nickey. So we are definitely not impatient to, I think the real quarter for us will be quarter three, Nickey, which will report in Jan, early Feb. Absolutely right. Quarter two, not substantial change because our IPO only happened on 22nd of September. But in terms of just broad headline numbers, our net debt was about 2,850 crores prior to IPO. That number now is about 1,830 crores as of date. That's the net debt. The finance cost or the interest cost has come down from about 12.7, 12.8% to about 10.5, 10.6%. I'm talking about what it is today after having actually already repaid the high cost debt. Now we expect the finance cost to even come further, but that will obviously happen by quarter four because that would include some sort of a refinancing that we need to undertake with the reduced debt levels, right? So as of today, net debt of about 1,830 crores, finance cost of about 10.6%, which is down from 12.8%. Quarterly finance expense have come down from about 130 crores last year to what would be just about 60 crores by the end of quarter three. A significant change there,
I think we've spoken enough and more about numbers, just a little more aerial view in that case. How is the demand stacking up on ground? Which are the segments which are witnessing traction? Any more strategy to kind of, as against your competitors? How are you moving ahead with all of that now that you're a listed company? What has changed for you? Let me ask that.
I think I'll answer it in two parts. One is obviously the broad demand patterns that we are seeing and how are we positioned vis-a-vis those broader industry demand patterns. And the second, what's a big change for us really, right? So in terms of demand trends, Nickey, they're very strong. I've always said it's demand supply 101. Demand continues to grow high single, early double digits. Supply is barely growing at 2, 3, 4% depending on which city you are in, right? So I think in terms of demand supply, I would be disappointed if anything changes quarter on quarter for several quarters to come, right? Two, as far as SAMHI is concerned, and as you rightly kind of articulated, we are present with 31 hotels in 13 consumption centers, and we are present across price points. So we have hotels like Holiday Inn Express hotels which sell at an average rate of 3,700 rupees, going up to upscale which can sell for an average rate of 12, 13, 14,000 rupees, right? So what we are able to do is capture a broad set of demand that is coming out of India's economic growth because we are present in business destinations largely, right? So as you see the office space growing, the airline sector growing, we believe we are well positioned in terms of locations. We are well positioned in terms of the brands that we carry on top of our hotels to take advantage of that. And as I said, we have delivered 17% rate growth quarter on quarter in the first quarter, and we see the same trend continuing in quarter two, going into quarter three, quarter four, right? The second part, what's changed for us, and I think there are two parts to it. One thing which we didn't capture in our conversation today was the ACIC acquisition. So as you know, we acquired this business in August of 2023, just prior to the IPO. That's why quarter one, quarter two will report SAMHI without that acquisition, even though in our management presentation, we always give a pro forma number, assuming if that portfolio would have been fully acquired, right? Just so that investors get a full sense of what the size and the scale of the business is. We believe the integration of that portfolio with SAMHI is where there's a significant immediate opportunities for ourselves. And what are those? First, we believe that as we integrate those, and those are all Marriott branded hotels, as we integrate those hotels with our Marriott operated hotels, there's some instant economies of scale. That portfolio is at a asset level margin of about 36%. We operate at an asset level margin of about 39% before some variable rents that we have. So there's almost a 3-4 percentage point opportunity of improving the margin in that portfolio, even if the revenue was to remain the same, right? Two, we also expect to improve market share of those hotels, because as they integrate with our shared services center, we expect the revenue growth also to be superior to what we have seen historically in that portfolio. So over the next 2 quarters, Nickey, a large part of what we can deliver, and I'm glad may not necessarily be market dependent, because integration of this portfolio, which is about 690 rooms, to our portfolio will bring significant advantages to SAMHI as an overall business.
So market share from now to the end of the year is how much and goes to how much?
So market share, Nickey, is difficult, right? Because it's a very dispersed industry.
Just a very ballpark understanding of what do you think your share might look like by the end of this year, given the kind of additions that you've been talking about.
So, Nickey, we go from 3,900 rooms to almost 4,800 rooms, right? That happened between July and September. That's a transformation of the business, right? So clearly, our scale today is substantially larger than what it was prior to the acquisition. Again, I said we don't have market share data because the market is very dispersed. I think it's difficult for any owner or operator to say that they have X market share in Bangalore. But what we can tell you is that we have significant inventory in markets which are growing really well. We have a very large inventory in Bangalore. We have 6 hotels there. We have very good inventory in Hyderabad. We have 4 hotels there. We have very good inventory in Pune, a city where we have almost 4 or 5 hotels now. So if you see, we have positioned ourselves as a dominant owner. I'm sorry, difficult to give exact numerical market share number because the unbranded branded supply tends to be pretty difficult to calculate. But what we can tell you is in cities like Bangalore, Pune, Hyderabad, we would be one of the most dominant owner of hotel inventory, right? And I think acquisition has just added to that advantage that we've always carried. And that inventory is carried at different price points, from 3,800 rupees to almost 14,000 rupees now.
Right. Just on a lighter note, World Cup is on. What kind of traction are you seeing because of that? How is the demand stacking up?
Nickey, one lesson we have definitely learned, and I'm sure media will also learn. These events really they have a huge impact for a few days. But look at my quarter 1, quarter 2. Quarter 1 RevPAR growth 14%, quarter 2 RevPAR growth 15%, quarter 2 had G20, right? Quarter 3 will have the cricket matches, and we are lucky in that way. We have 3 hotels in Ahmedabad. Again, probably we are one owner which has a very large share of inventory in Ahmedabad. For those 2 days or 3 days, India, Pakistan, and the finals, clearly it's going to be a home run, right? But we got to look beyond that. We actually think a lot of excitement that we are seeing in the first 11 days of October, Nickey. I wasn't surprised, but let me tell you, actually it's not necessarily just Ahmedabad. It's also Bangalore and Hyderabad, right? And there it is repeatable, recurring, I hate to say it, boring business demand there,
All right. On that note, we'll just leave it at that. And thank you so much for taking out the time and speaking to us.
Thank you, Nickey. Thank you. Always a pleasure to speak to you.